Good morning and welcome to Stock Market Today. It's Monday, June 29th, 2020. This is your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Follow me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the great content for this show, as well as give you daily stock ideas to consider. And that hits your inbox every trading day before the market opens. I hope that everybody had a great weekend. Let's dive right in. Just a reminder, this is a holiday shortened week with markets closed on Friday in observance of the 4th of July holiday here in the U.S. So U.S. equities were weaker on Friday and closed near the session lows, pushing equities lower for the week. All sectors finished in the red. Utilities outperformed on the day, while comm services was the worst performing group. And we'll take a look at that a little bit later on in the show. Treasuries were stronger with the curve flattening. The dollar was mixed on the major crosses. Gold was up 60 basis points. WTI crude finished down 1%. So while all sectors were lower, your outperformers were utilities, healthcare, and materials. Your underperformers, comm services, financials, and energy. Now, as we get to the desk this morning, it's a little bit of a mixed bag in the futures. S&P futures are up 20 basis points despite more news over the weekend of regional outbreaks of coronavirus here in the U.S. European markets are trading higher on the heels of what was broadly weakness in Asian markets overnight. Treasuries are unchanged. The dollar is down against the euro, but flat against the yen cross. Gold is up 20 basis points. Oil is weaker. WTI starts the week off down about 30 basis points to get us going on a Monday morning. Let's look at the structure of the S&P 500. We are what I will call dancing with support. As we did close below the 200-day moving average yesterday, you have to kind of look really closely and squint to see it, but we did close below that blue line, the 200-day moving average. Now, the 50-day moving average is rapidly rising, right, to create a really what should be a solid zone of support, right, between 2950 and 3000. Near term, we're still calling 3000 to 3100. The main support zone, 2850 to 2950 below that. The February highs remain in play if support holds, right? If we break below 2850, we have to start thinking about what the downside structure to the market looks like. Resistance in the 3150 to 3250 range in the near term. That 3150 area has been a solid wall over the past couple of weeks. Remember this gap that opened around the June 9th, June 10th timeframe, right? Subsequent rallies have been unable to push through or even close that gap. So 3150 becoming a little bit of a brick wall to the upside. That gives you information, right? If we do break through there, obviously it's important, and then you can start thinking about the February highs. Now, we do enter the week near oversold conditions. Chaikin money flow is bullish, but waning. You can see here it's starting to move lower back towards that zero line, which to me is not that big of a deal. We've kind of seen for the most part just brief trips below zero over the basically since the March rally started. So very much a similar structure to what we've been talking about for the past couple of weeks here. I think that the importance of this 3,000 level is really becoming solidified with continuous tests, right? Same as 3150 to the upside's been tested a bunch of times. So is 3,000, right, to the downside here with this where the 200-day moving average and now the 50-day moving average begin to come into play. So that's the structure as we enter the week. So we do start the week at or near oversold levels. That's based on our overbought, oversold indicator. The rising COVID case count remains a key focus, right? A lot of news on that over the weekend. But the advertising boycott on social platforms should not be ignored, and that's where the comm services group comes into play. We'll talk about that and look at that chart. Treasuries remain bid with strength at the long end of the curve last week, and futures point to a mixed open here today. Now, as we take a look at the major indices from a power bar perspective, we did see some deterioration last week, and definitely on Friday. Dow down 2.8%. 3 bulls to 14 bears there. S&P 500 down nearly 2.4%, 69 to 151 bulls to bears on that metric. The NASDAQ was down a like amount and saw some deterioration in its power bar, 30 to 16 there. Small caps underperformed slightly, 454 to 317, bulls to bears. Bonds were bid in a bit of a flight to safety, up 1%, sending yields lower. According to the Chaikin Power Bar, large cap stocks are more bearish than small cap stocks. The major markets across the board remain mixed from a power bar perspective. Now, let's look at our stock of the day today. Cisco Systems, one of these oldies but goodies, if you will, from the .com era. Cisco has a bullish Chaikin Power Gauge rating. Strong trend above the rising trend line. Strong industry group. Comm Equipment is a strong industry group from a power bar perspective. Now, what I see is a rating that for the first time in a year recently turned bullish. That intrigues me, right? Because it's been mostly neutral or bearish for the better part of 12 months. And now we receive a bullish rating here. So that catches my attention. At the same time, we see a spike in relative strength with the overbought oversold indicator beginning to move higher from an oversold condition. Likewise, big spike in Chaikin money flow as Cisco did trigger two of our buy signals today, a money flow buy signal and a relative strength buy signal. So when I roll all that up, that's really interesting to me. A bit of a change of personality, if you will. Right? Notice what's happening here. A year ago, we had persistently bearish money flow. Now we're starting to see persistently bullish money flow, indicating to me that Cisco could be under accumulation. I think that if you're looking for bullish ideas as the market tests key support, you want to be looking within the tech sector, right? Tech has been strength, right? You have a little bit of a theme here as well due to support from the White House for strengthening U.S. companies' positions in 5G relative to Huawei. Cisco all of a sudden really looks interesting to me as a bullish idea. I highlighted in my note today for Chaikin clients, and I'm highlighting it for you here today on the show. Let's take a look at the sector tracker now. We dip back to all 5 sectors being lower over the past 5 days. I'm sorry, all 11 sectors being lower over the past 5 days of trading. Tech still at the top of the list. Your outperformance, discretionary, holding up better than the overall market. Materials and healthcare round out the top 4. Now, Utes, staples, industrials, and REITs are middle of the road. Comms really hit hard on Friday. Started to hear about advertisers boycotting some social media platforms such as Facebook and Instagram and Twitter getting hit as well. So that really weighed on the comm services group. Financials under pressure after the bank stress test and some commentary on limiting buybacks and dividends in the third quarter. And then finally, energy. You know how I feel about energy. We'll note that over the weekend, Chesapeake did officially file for bankruptcy. Turning now to our industry in focus. It's one that we haven't talked much about. We wrote about it a couple weeks ago as being weak and likely to remain so. And I do think that that remains the case. It's aerospace and defense services, which has lagged the S&P 500 by 19% over the past 6 months. Power bar ratio, which measures future potential, very weak. 10 bearish stocks for 2 bullish stocks, currently ranked number 19 of 21 subsectors. Did move up 1 slot over the past week, but still a fairly weak group. Taking a look at some of the stocks there that we want to avoid or potentially look for bearish opportunities if they set up. TransDigm, TDG, Parsons Corp, PSN, both with very bearish ratings. Aerojet, Rocketdyne, AJRD with a bearish rating here at Chaikin Analytics. And let's dive in on the chart. Here's XAR, the ETF that tracks the aerospace and defense group, has a neutral rating. The ETF rating is neutral. Trend is weak, right? Below a declining long-term trend line. Contrast that with a lot of the other stronger groups in the market where they're above their trend line. Money flow bearish. Fund is oversold. But what's interesting to me is you notice this group has been underperforming since last October. For the most part, since last October. This was a weak group going into the February-March downturn, and it's remained weak. Remember back in that time frame, what we said you should be doing is looking for the groups that hold up the best. Those are your likely leaders. That's largely played out. Bigger picture trend perspective. Likewise, the groups that were weak heading in after a brief reprieve are reasserting their weakness on a relative basis, and you can see it here. Space and defense starting to see the intensity of its underperformance increase again. So below the trend line, bearish money flow, underperforming, just not a group that's all that intriguing to me in the here and now. Let's look at Friday's movers and shakers, our gainers and losers. Gap up almost 19% on news that they were partnering with Kanye West. I never would have seen that coming, but I don't think anybody would have seen that coming. Clearly, the stock was up 19%, but that was the news. So interesting to watch how Gap continues to play out. Bank of America upgrades NetApp up 5%. F5, FFIV up 3%. eBay caught an upgrade from Deutsche Bank to send that stock higher by 3%. And here's Cisco, right, higher by 2.4% on the news of White House support for U.S. companies in the 5G space as an alternative to, to increase their competitive positioning relative to China's Huawei. So could be a bit of why F5 was strong as well, but something to play out. 5G, a key investment theme. I think Cisco, as I said, I just walked you through the chart there. I think it looks interesting. And now you have that potential tailwind of support from the White House. Loser side of the board, all coming to us from the financials, all the banks. We had the results of the stress tests with commentary on buybacks and capping of dividends in the third quarter. That really weighed on the banks on Friday. Financials were an underperforming group. If you look at XLF, took out a key support level at $23 with the banks under pressure. We'll see if we get a snapback rally or if that's a trend that continues. But I know the banks have been a widely watched group, especially with rates looking like they want to stabilize, renewed pressure on the banks. I never really got there. I didn't get excited about the banks. Some people were starting to get excited about the banks. I couldn't get there because my base case view is that rates are heading lower. Throw in this added headwind from the stress tests, and I think the banks just continue to need more time. Let's look now at the charts. Here's your comm services. Look at that big black bar here, this big filled in bar, open near the highs, closed near the lows, on news that advertisers were boycotting or beginning to boycott social platforms such as Facebook and Twitter. Group under pressure. That's the news, right? What do we care about, though, from a technical level? We care about this $51 level, or really $51.20. That is kind of the top end of what was support in 2019, right? A little bit of a cluster here. 200-day moving average, right, which is relatively flat at that level. RSI beginning to break down after making a lower high. We'll see if it can hold bullish ranges, right? So ideally, if you're looking at this group, you want to see $51 hold. You want to see RSI hold bullish ranges. And importantly, on a relative basis, you want to see this consolidation zone hold. Right, it's going to be interesting to see how it plays out. I do know that Facebook is under pressure here again to kick us off on a Monday morning. So I think it's something that we'll be watching closely, because I think that if you're looking for potential catalysts to take the market down, I mean, we're all paying attention to the COVID numbers, right? Contrast that with back in January where people were kind of dismissing COVID, right? Calling it just the flu, if you recall. So to me, I don't think it's something that everybody is watching that's likely going to lead to the big downside. It could contribute, but I think something that comes out of the blue, like this advertising boycott on social platforms, if it gains traction, could be a catalyst for support to break in the broader market. So this is something I think we should be paying close attention to with further news coming out over the weekend of additional companies joining that boycott or temporarily halting advertising on these platforms. Long-term treasuries start to rally. Take a look at TLT here, right? After going into a consolidation, after people starting to talk about the reflation trade, right? Long-term treasuries came under pressure, but what I see now is a break up and out of this triangle pattern above the 50-day moving average. Notice the RSI never became oversold and is now working back towards bullish ranges. And take a look at TLT relative to SHY, long-term treasuries to short-term treasuries, topside breakout through this downtrend line. Important for the growth versus value trade. Finally, taking a look at dollar and commodities, the dollar UUP has held once again that key $26 level, rounding out of an oversold position in this 13-period CCI continuing to work higher. I think if the dollar holds support and continues to work higher, you have to look for treasuries to come under pressure, throwing further water on the reflation trade. That's going to wrap us for Monday. Take us for a test drive for 14 days. I will be back with you tomorrow.